Hi, everyone, and welcome to our Research at Citi podcast. I'm Rowe, U.S. Regional Director of Research. I'm joined today by Nathan Sheets, our Global Chief Economist at Citi. And the topic is AI productivity. This is a really important topic because I think the markets and everybody has now reached a point where deployment of AI has been going on for a while. There's been an enormous spend institutionally on AI, and now we're all eagerly expecting to see the results that AI investment. And Nathan, you just recently led a must-see report that we've done on productivity in the AI revolution. And I'll be very curious to know right now what the results of that report are portending. But let's first start off. What are you seeing so far in terms of AI productivity? And maybe we can start there, and maybe you can describe the report a little bit and the approach that you took.
Yeah, thanks, Rob. This issue of AI and its implications for productivity, we see this as probably the most important issue framing the global outlook and the outlook for the US economy over the next 5 to 10 years. If we do see an acceleration in productivity, say similar to what we saw during the internet boom of the late 1990s, that would mean faster GDP growth. It would bring lower inflation. It means higher real wages. It means higher profits for US firms and other firms around the world who are adopting these AI technologies. It's about as close a thing there is in economics to a free lunch. So this really is a watershed set of issues. Now, specifically on what we've seen so far, we spend a fair amount of time in the report analyzing the recent trajectory of productivity. And candidly, we don't see an AI imprint in the data yet. The more important force over the last few years driving productivity has been the pandemic and the after effects of the pandemic, the post-pandemic normalization. When we look at investment data and the like, our expectation is that perhaps over the next few years, we might start seeing that boost to productivity, but we haven't seen it yet. And that is one of the findings. It's a negative finding. We haven't seen the productivity data respond.
And when you say that productivity has improved post-COVID, is that as a result of an adoption of other technologies? I know, for instance, my anecdotal experience has been that Zoom has produced productivity benefits, but I mean something along those lines.
I think that that's a possibility, but it really feels the word that we use is kind of a cyclical recovery of productivity. That there were some forces in play post-pandemic that depressed productivity, and now cyclically we're coming back to normal. And indeed, over the last few years, the pace of productivity growth has been very similar to the 70-year average that we've seen over many decades.
And I think that there's an MIT report out too, right? A paper they've done that would also suggest that adoption has not quite solidified yet.
So let me frame it this way. In 1987, Robert Solow, a famous MIT economist who won the Nobel Prize, was looking at the economic data and thinking about the IT revolution. And Solow said that the imprint of the IT revolution is everywhere, except for in the productivity statistics. And that kicked off a lot of analysis and research in economics and elsewhere as to, well, why are we not seeing these gains? Well, with the benefit of hindsight, we know that they eventually came. And through the late 1990s, we finally got to a point where all of that investment that had occurred actually started yielding a productivity benefit. And this has given rise to a really important concept that we stress in the report called the productivity J curve. And specifically, up front, you have firms that are investing in a new technology. But before all of that investment really yields fruit, you've got to first have a significant quantity of it. You need a critical mass. Secondly, you've got to train workers. Third, you may need to adapt your production processes to accommodate the power and potential of this new technology. and various economic historians and others have kind of traced through these J-curve effects for the adoption of electricity, for the internet, and for computers, and kind of that J-curve. And what's clear is that we're still on the flattish or even declining part of the J-curve. But as I said, when we do the analysis, our expectation is that at some point, and our best guess is maybe within the next few years, we're going to move into that steeper portion of the J curve.
And I mean, this is not for lack of capex or investment by a lot of companies. How have you looked at that, and how do you define how impactful that investment has been, and also relative to prior periods?
Yeah, so to be clear, and like other cycles of major technology breakthrough, there has been a substantial investment in AI-related technologies. And consistent with that, we develop a new measure of AI investment, looking at macroeconomic data, mostly related to various kinds of detailed components in the national income accounts and data from the Census Bureau. And when we put that together, our estimate is that during the first half of this year, the United States was seeing something on the order of $255 billion of AI investment at an annual rate. So we are seeing significant investment. And our sense is that that investment that's occurred has lifted US GDP growth over the last few years through these demand side effects by maybe a quarter to a half a percentage point a year. So we're certainly seeing an accumulation of capital, but not quite yet, we would argue, to that critical mass point where you get the takeoff in productivity.
So to be more precise, Nathan, what should our expectations be in terms of how adoption will take place? Like you said, a few years. Is that 2? Is that 5? And also, what are your expectations of its impact on GDP? And I'm thinking also specifically about the turn of the century. It kind of led to a tech bubble in markets, but that tech growth, I think real GDP was pretty high back then.
The sweep of our analysis is that rise in productivity is coming. There are no tools that are sufficiently precise to answer the question, is it 2 years? Is it 4 years? Is it 6 years? But candidly, when I look at results that we present, it feels to me more like within 2 to 3 years, we'll start seeing it in productivity. And I'd be surprised if we don't, rather than 3 to 5 years. And so that window in which we will feel that boost to productivity growth is shortening. I think once we feel it, we run through another set of analyses and another set of results in the paper where we actually walk through a process, looking at academic work and evaluating it and so forth. And we estimate that it's plausible to think that once this thing really gets going, we could have a percentage point higher productivity growth for as long as a decade. And you'd think that that would essentially pass through, that instead of US potential GDP being at 2 or a little bit less, that maybe we could be in the upper 2s or even 3% for a sustained period on the back of this productivity boost.
And when you looked at this period relative to prior periods, are there similarities and differences that you may have observed? I always think about the turn of the century, but there are obviously other periods along the way. There was the advent of the internet, et cetera. Are there any similarities or differences that you see?
In this case, the most striking difference for this AI revolution is we date the beginning of really the acceleration of this AI period as the announcement of ChatGPT technologies in late 2022. And what is striking and is different is just how fast AI technology is diffusing into the economy. For many other key technologies, and I mentioned the adoption of the electrical motor, we could think about the internet, you could think about the steam engine, the railroad, and so forth. It was literally decades before they bore significant fruit. So this feels like a greatly accelerated kind of cycle that we're seeing. And maybe that reflects that the world just moves a lot faster now than it did 50 or 100 years ago. Maybe it's also reflecting, we have some colleagues who follow individual equities who focus on this sector. They recently put out a report where they referred to AI as the apex IT technology. And maybe it is correct to not kind of think of AI as a separate technological cycle, but just a continuation of the IT boom. And that's the reason why it's moved so quickly. But the speed of the diffusion in this case has been breathtaking. And then I think the similarities are the potential capacities for a transformation of productivity and what it means for firms and the need to reorganize and the need to train workers and change business processes. I think a lot of that, those lessons from the internet period and its adoption are very relevant for AI technologies as well.
When we think about it, what are the implications for markets? I mean, we've obviously seen markets gravitate to this, and it seems like markets are all in on this development in terms of the way investment dollars have moved. But what are the implications going forward right now?
This is a focus of one of the chapters of our report. So we do all this analysis, this macro and this faster growth and the investment and the pace of diffusion and so forth. What does all of this mean for financial markets? And what's clear is that this is, a huge benefit for financial markets by and large. And specifically drawing on past episodes of productivity gains, it should suggest, holding all else equal, higher equity prices, higher real bond yields, and higher return on capital in the corporate sector, a stronger dollar, and notably, a somewhat lower real price of gold. Step back and think, when does gold move up? It moves up during periods of uncertainty and during periods of rising inflation. If we're in a world of ongoing productivity gains, that's lower inflation, and people are nervous, they're happy. And one of the features of these productivity intensive episodes is a lower real gold price. Now, where it gets really interesting, though, is that when I look at the equity market and when I look at the dollar, maybe this is a little less true for bond yields, but when I look at the equities in the dollar, they're already pretty strong. And we think about the narratives that have supported those markets. I mean, AI and expectations for this technology have been key drivers of the strength that we've seen. So I think there's an argument that some of this is already priced in, which then is suggested as it occurs, maybe the response, there's still no doubt more to come. It wouldn't be as significant as one might think, but it also highlights a downside risk. And that is if these AI gains come more slowly than I've described and more slowly than has been priced into the markets, or end up being less powerful than we expect, that creates an important downside that I think investors need to be aware of, is that I'm talking about what my expectation is, but could it be longer? Could there yet be roadblocks and speed bumps along the way? Absolutely. So on the one hand, I want to be optimistic. I'm still a two-handed economist, so I want to say proceed with caution.
Could you opine a little more specifically in terms of that adoption period? You mentioned three things in terms of the J curve: training workers, critical mass, and I guess the overall adoption processes, or the processes need to change.
Organizing the firms, yes.
Yeah, can you elaborate a little more on that in terms of how that affects adoption?
So, a good kind of background discussion is in 1990, when they were struggling with where are the gains from the IT revolution and productivity, why aren't we seeing them? A Stanford economic historian named Paul David did a very interesting piece where he looked at the adoption of electricity. And I've referenced this a little bit, but more specifically, the adoption of electricity in the United States. And he found, and this is a really important point, that before the gains from this productivity were harvested, you needed to have roughly 50% adoption across the economy. And so if you want to think more specifically, and I think that's what you're driving at, is more specifically, when are we going to get there? It is at a point where you've got roughly a 50% adoption and usage rate. Now, when you look at survey evidence out there, broad evidence that essentially all firms are experimenting, or at least contemplating experimenting with AI in one way or another. But at the same point, that MIT survey that you or study that you referenced earlier, plus an independent survey that we did at Citi, point to, yes, all these firms are experimenting, are thinking about, are deploying in various ways AI, but really only 5% of the various applications are fully scaled and profitable so far. So what is deployment? We can debate, but my instinct is we still have a ways to, we're on that path, and adoption is proceeding rapidly, but we're still not quite at that 50% threshold yet. And that's a way to think, when are we going to get there, so that, half the corporate sector, say, is actively, meaningfully deploying AI, not just kind of as a talking point or an artifact, but as a deep part of their production processes.
And in the report, do you look at how the rollout is happening by industry? In other words, I think you allude to the fact that the services industries will be the initial beneficiaries or may adopt quicker than some other industries. Are you seeing a roadmap there in terms of industry specifics?
I think that the research so far kind of points to it really indexing on more flexible kinds of firms. And small firms, new startups, firms that arise, they're going to be firms that arise explicitly to deploy this new possibility as a result of AI and these new AI technologies. Think, for example, of Uber, that kind of arose on the back of the internet. And these firms that are specifically designed or more flexible, more growth-oriented, are likely to deploy more rapidly. And we do have a lot of small firms in the services sector, and I think that they will absolutely be deployed. Now, the advantage of large firms is they've got deeper pockets and they have more resources. And I think, they may be less fleet-footed than the smaller firms, but having additional resources may actually be helpful. And then specifically across sectors, I really think the jury's out on that. One place where this is being debated is in the equity market, where so far equity prices for what we call the AI enablers or the AI producers have surged up. But now that equity trade is broadening to AI adopters. And I think the markets are kind of asking the question you did, which firms, which sectors are the ones that are going to benefit? I think there's, arguments that it could be pharmaceuticals, it could be media and entertainment. It may yet transform. We have e-commerce. It may transform retail and commerce in ways that we're not, currently thinking through. But I think ultimately your question of who really, beyond the AI producers, are the adopters who are going to win this thing? I think that still remains to be seen. And I think there are a lot of possible candidates.
Well, Nathan, I could go on. We've run out of time here, but thanks so much for all your insights. They're very valuable. And hopefully, I think we will have the public version of this report in the show notes, but there will be an institutional and a public version of the report out. I look forward to reading it thoroughly. Thank you again, Nathan.
Thank you. Pleasure.
This episode of Research at Citi was recorded on Tuesday, September 9th, 2025. I'm your host, Rob Rowe.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.